Hello everybody, welcome to another update on the Gold Forecast Index, the holy grail to predict gold prices. In my last video, I said that there could be a correction because of June. June is seasonally a weak month, and we got that correction. So now we need to see what is the status on the gold market, and let's take a look at the data points. So the gold forecaster index has a new data point and it looks flat. So that means we are safe. Gold will probably be in a trading range in the coming months and it's in a bottoming out process. So we could have a stable gold price in July and August, and then we will see if it can go higher. But as you can see here, we are still in positive territory, and that's good. So we should see a higher gold price. Taylor roll rate, no updates. This is still pointing higher. We had a higher unemployment rate, so that should be positive for the gold price. Nothing to see here. GLD levels are very stable. Also, the COMEX gold numbers are very stable. I don't think there is a lot of volatility in the gold price. Deliveries went down a bit in China. China also, we are seeing here that the silver inventories keep going down. So whenever this happens, that means that silver is a bit weaker. And we are waiting for a pivot here. So at each pivot, we see that the silver price will move higher again. Pivot, and then it goes higher. And we are waiting for a pivot here. So we could see some weakness in silver until China starts buying again. Nothing to report here. US mint sales were at 0. That was very interesting. So in the whole month of June, there were no US mint sales for silver and just a little bit for gold. But probably in July, the US mint will start selling silver eagles again. Premiums are still at 50%, so I'm still waiting for it to go down, and that will be positive for silver and gold. The PSLV premiums have gone down, so that's not a good sign. The Wall Street bet silver people are not buying that much silver anymore. The gold COT report looked very positive. You can see that the open interest has gone down and the shortest have gone away. We still need to get rid of all these shorts, of course, but we are getting there. Silver was not that great. Open interest is still very high. But also here we saw that the shortest are gone almost. You can also see that here the swaps get more long. That's a good sign. So that points out that we are bottoming out. I created this new chart, gold vs GOFO rate. And you can see that when the backwardation occurs, and that's at these points, the low points in the GOFO rate, you can see that when this happens, then the gold price goes higher. So this should be a very bullish sign for gold to go higher. because the go-for rate is almost negative, which means that we have backwardation. Lease rates were positive, I think. Then the tips yields. I want to point out here that we have this range here between the blue and the green line, and gold should be in this range. It went too high here in June, so we have this correction now, and now it's too low. So this can actually go back to 1800 in the coming months. Seasonally, we are very strong in July, and it will get even better in August and September. So this is the perfect moment to start buying. Same for silver. July is a very good month for gold and silver. Technicals still bottoming out and then going higher. Charles Nannett also says we are bottoming out and going higher after the summer. Let's take a look at the inflation numbers. We are still having lots of inflation. And I have added this new chart of the 10-year break-even rate because this is actually a leading indicator. So this is a very important chart to watch. If this goes back higher, like this, then the CPI will move higher along with gold. And here you can see the correlation between the break-even rate and the CPI. So it went down a little bit here, but I expect that we will stay elevated here. PCE went down a bit, but still very high. So I think inflation is still here. We are not in deflation yet. Capacity utilization, let's see, we are going up. That's inflationary. And then we have the deficit numbers. So the deficits actually went up, which means this goes down in May. Services went up a little bit, so that improved just a little bit, but overall trend is still down. Yeah, this is still going down, more and more deficits, and this is not improving at all. There's still this gap, and this gap between export and import prices is actually getting bigger. So deficits will keep going on, and also the prices will rise. This is a good sign of inflation. Imports and exports gap is still very large. So we're still in the same situation as always. More inflation, more money supply increases, currency in circulation still up. So this is all inflationary. We got non-farm payroll numbers, and they were actually very good, but the trend has changed to the downside, as you can see here. And also the unemployment rate went up from 5.8 to 5.9. So the unemployment situation is actually not improving, and this should be good for gold. Same can be seen here. It is not improving. Now let's take a look at the central bank balance sheets. The pace of increase of QE is actually steeper. So I think Powell is printing more money, and ECB is also going to print a lot of money. So that's all very positive for stocks and gold. And I wanted to talk a bit about the reverse repo again, because a lot has happened. So on this chart, you can see that the reverse repo purchase agreement here, that's the blue line, is actually going higher. Okay, so that's the reverse repo line on the liability side is going higher. So in order for that to happen, some other things need to go down, of course. And what is going down? You can see that the Treasury General Account is going down. That's the purple line. That's the actual cash in the Treasury. And also this green line is going down, which is the other level. They call it other, but that's actually bailout money. So some of that bailout money is getting into the system. And what's also going down is the reserves. So normally these reserves from the banks should be going higher when the TGA goes down, but that's not happening. It's kind of stuck on the 4 trillion level, and they aren't going higher, and there is a reason for that, I think. And that reason is, let's take a look at this. So you can also see here that the reverse repo is going higher because they want to make sure that this effective Fed funds rate doesn't keep going lower. So they need to push it higher. You can also see here on June the 3rd, 30th, it went down. So they had to push it higher again. And that's why we had a spike here in the reverse repo. But let's get over the reason why these reserves cannot go above the level of 4 trillion here. You can see that it is capped here. And the reason is that these reserves parked at the Fed, they have an increased cost associated with it. And what's that cost? You can read this here. There's costs for high levels of reserve balances. And when you read through this, you can see that there are higher non-interest expenses associated with it. And also the ratios, the capital ratios are at risk. This is the most important here. The banking system as a whole must hold whatever level reserves the Fed establishes. So unless banks reduce other assets by an amount equal to the rise in reserve balances, these capital ratios must fall on average as reserves rise. So capital ratios need to fall when reserves rise. That's the problem that we have. And when capital ratios go down, then you get this problem here. Capital ratio goes down, you do not have enough tier 1 capital, tier 2 capital, and then the loans of the banks will go down. So that's in a nutshell what is happening here. They have too many reserves here, and that is not good for the capital ratios and the non-interest expense. So that's why this happens. So all of those reserves are going into the reverse repo in order to cap the reserves. This is also an interesting chart. If the amount of reserves goes higher, then this line goes down. And this line is the effective Fed funds rate minus excess reserves. So in order to go down, either the effective Fed funds rate needs to be going down, or the interest on excess reserves needs to go up. So this is pressuring Fed funds rate down, or the interest on excess reserve higher. And this is what's happening here. You see that reserves are going up. This is the reserve line is going up, and that has pressured the Fed funds rate lower. This red line here, lower, and has also pressured the Fed to increase the IOER higher. And that has also happened here. The interest on excess reserves has been increased by the Fed. So they're actually managing this problem here of too many reserves. And we'll see what will happen here. Because when this purple line goes to 0, then something needs to break. Something will break. And we will see that very soon in the coming months. Here you can also see that excess reserve balances are correlated to the IOER minus Fed funds rate. So this is the correlation. And that's just what this chart means. Now, gold miners, let's talk about gold again, are very cheap. You can see that gold mining stocks have an enterprise value that's very low compared to EBITDA and are very cheap compared to stocks. So you need to get into the gold mining space. We also got numbers from the BEA that the US is not doing very well. A lot of US liabilities and no US assets. So the balance sheet of America is getting worse and worse. And this will also be very good for gold because they will just inflate away their liabilities. Now, the reason why gold hasn't done well recently is because we have a lot of US dollar shorts. So these are all shorts and they need to get flushed out. So they're positioned very short. We could get some short squeezes on the dollar, which pushes the dollar higher temporarily because the US dollar is just going to crater to 80 eventually. Now, something else that I need to say, we had a Fed meeting in June, and the old dot plot said that we didn't have any rate hikes, but the new dot plot looked like this. So there could be some rate hikes in 2023. That's what they said. They also said that unemployment would go down, unemployment rate, and GDP would go down a bit, and inflation would subside to 2%. We will see if this will happen. But I think this is all baloney because in order to hike rates, you need to taper first. And that's what Yardeni says. When you look at this, tapering may be months away and hiking the Fed funds rate won't start until at least a few months after tapering is done. So we need to first taper before we can rate hike. But tapering, when will tapering start? It will only start when lending increases. So the red line is the lending, and that needs to increase before tapering can start. For example, here, lending went down, so they did a lot of QE as the blue line. And here we see that lending increases, and then they tapered. The blue line went down. And then when lending started to become bad, then they started tapering again. So these things go negatively correlated to each other. It's a very nice chart here. And you can see now the red line is still down. So they cannot taper at this moment. This line needs to be positive first before they can start tapering. So please watch this loans and leases chart, because this will tell us when the tapering starts, and this will also tell us when the rate hike starts, because tapering needs to be done first before we can rate hike. So there's a long way to go before we see any rate hikes that will be bullish for gold. Very important. We also know that Fed is allowing bank dividends and buybacks from July onwards. So that means that they are using the cash on their balance sheet to buy back shares. And yeah, share prices will go up. Now that cash will go to the shareholders, of course. And the shareholders will start selling those shares, and that's money that will be flowing into the economy. So this is in fact a stimulus for the economy. So I expect that stocks will keep doing well in the future. And as money flows in the economy, they will start pushing up asset and consumer prices, which will be good for commodities and gold. Just a last chart here. US CPI is expected to keep growing to 7%. So more inflation will come. And this is a very nice chart, very correlated. And it is predicting that the CPI will go to 7%. We are now at 4%. So there's still a lot of upside here to come. And this will actually decrease the real yields. Inflation up, bond yields down. So that gives us a lot of inflation, because real yields are going more negative. As you can see here also, China is not exporting deflation anymore. They are now exporting inflation to the Western society. That's because they are not buying treasuries anymore. And this will just exacerbate the problem of inflation. So that's our conclusion here. Watch for gold to go much higher, but we still need to bottom out in the summer. And I'll see you in the next video.